Hello, everyone. We're going to get started here. Sorry about that. Welcome to our live event introducing BondVALU. Just a quick note before we begin. This session is being recorded, and all registered participants will receive a link to the recording afterwards. If you have any questions during today's event, please use the Q&A panel located at the bottom of your screen. You'll see it there. And we'll take a look at those and try to answer as many as we can after the presentation. If you're experiencing any video issues, try logging out and back in again. That usually resolves the problem. If for some reason you are having major difficulty, like I said, we'll be able to send you a link to this live event after it concludes. So I'm president of DPC Data, and I'm pleased to introduce our two panelists for today. First, we have Triet Nguyen. He's DPC's Vice President of Strategic Data Operations. In his current position, Triet is responsible for developing financial data and climate risk solutions for the municipal bond market. He's also a widely published author and thought leader on municipal credit and climate change topics. Prior to joining DPC, Triet spent over 4 decades in various capacities on the buy side of the market, from credit research to portfolio management at institutions such as Putnam Funds and John Hancock Insurance. He's the author of Investing in the High Yield Municipal Market. If you have a copy of that, you should hold on to it because I saw that it's going at upwards of $100 on Amazon. We also have Michael Furla. Michael is the founder of BondDATA and senior consultant to DPC Data, which recently acquired BondDATA back in June. Michael is a chartered financial analyst and certified financial planner. He began his career as a municipal bond rating analyst at S&P Global Ratings. He later worked as a fixed income methodology engineer at Morningstar and went on to the buy side to serve as chief investment officer, overseeing $12 billion in client assets. Welcome, gentlemen.
Thank you.
Yep.
Thanks, Ken.
So today, a quick agenda for today's call. Our panelists are going to give you an overview of what BondVALU is and how it came to be. They'll take you through a product overview, including the asset classes, sectors, and total CUSIPs it covers. They'll discuss financial benefits to users, including cost savings, and maybe more importantly, the potential return alpha that can be generated by using BondVALU. They'll discuss how BondVALU is distributed to clients and wrap up with a summary of the product's value propositions. We'll also make sure there's time, like I mentioned before, for Q&A. So as we go along, if you have any questions for Triet, Michael, or maybe myself, please use the Q&A link again at the bottom of the screen, and we'll make sure we'll get them addressed. So let's begin.
Thanks for the kind introduction, Ken. We're pretty excited to have this opportunity to unveil what we think is pretty unique new tool to help separate account managers identify attractive bonds for their clients. And the best part of it is, it's a product that was designed by one of their own. As a former trader and portfolio manager for a large Boston-based mutual fund complex, as well as a former SMA manager myself, I've always found the process of assessing municipal and corporate bond offerings to be quite time consuming. You essentially have to kind of make sure you select the highest yielding bond for your client's target quality and maturity range. And if it's a credit that you're not up to date on, you have to turn to your desk analyst, if you have one, to make sure you're not taking on a potential credit problem. So the entire process can be very cumbersome, to say the least. Michael, thanks for being with us. I imagine that the bond selection process can be exponentially more complex for separate account managers because you guys have to deal with thousands of bonds a day, very often in small lot sizes and for smaller, thinly researched bond issuers. As an SMA industry leader, were these the pain points you were targeting when you created the BondVALU app?
That's exactly right. What's challenging is you're dealing with hundreds, if not thousands of accounts. And within those accounts, you have to manage these separate portfolios. And when you go out to the market and you're identifying opportunities to replace the maturing bonds or called bonds, there are thousands to choose from. And I was looking out in the market for opportunities to streamline this process, a one-stop shop tool that allow me to screen potential bonds for the portfolios that would look at the underlying credit fundamentals, but also make sure from a return profile, the relative value was there. So it was appropriate for the account and the overall strategy. So looking, I didn't really see much out there. So that kind of led us to this point of if it's not there, let's try to build it. Yep. And that goes into our collective experience and backgrounds. So from 4 different aspects of the industry, we have a research background regarding S&P Global Ratings, building rating calculation models and engines, and then a data perspective as well. DPC's extensive municipal bond database. Additionally, we had a lens into technology, building out and developing fintech products and applications for financial service institutions at Morningstar. And on top of that, we had experience on the buy side, managing portfolios, being on the front lines regarding trading, portfolio management, surveillance, you name it. And combining those 4 unique experiences, we're able to see the industry, what the gaps were, and develop BondVALU. We're able to fill in the void, so to speak, and to solve the problems to help streamline the process and give back time. Next slide. So exactly. So the solution to the managing multiple accounts, screening through thousands of bonds is through this patent pending proprietary technology. And we utilize a first principles quantitative approach. We broke down the problem to its core and identified ways to automate credit momentum evaluation, relative value evaluation, and combine those two into a simple, easy to understand bond summary score. What we're trying to do here is democratize fixed income investing and make it easier for advisors and market participants to do well in the market.
Sounds very intriguing, Mike. Let's dive right in. Please show us how BondVALU works.
Absolutely. So what you see here, and I know there's a lot on the screen, so we'll begin from left to right. You have your descriptive bond data. So for instance, on the left side, you see the bond description. For municipals, you have the state column. You also have an industry column, QSIP, the yield of the bond or QSIP you're looking at, and then the curve rating as well. Whether it's a AAA curve, AA, single A, and so forth. And then the curve percentage. So along that yield curve, at the maturity rate and rating, what is the actual rate of what we call the benchmark? So that's more descriptive data. We go to the next slide, you'll see what you're paying for here. And those are the core factors of BondVALU. We'll begin from left to right. We have the yield alpha percentage. That's a difference between the yield of the bond you're looking at to its benchmark yield curve. And then we also have the credit momentum score, which looks at the fundamentals, the relative value score, and then finally, which is very unique to the industry, the bond summary score. And we go to the next slide. Regarding credit momentum, this reflects the trend of the underlying credit ratios and factors. It's looking at economic indicators, financial and debt indicators, and it combines them into a score to identify if a credit is trending stronger or weaker. Because right now, the credit rating agencies, they do a great job, but there can be a delay from when there's new information available to the next rating outcome. Because you have to take it through investment committee, you have to write the rationale. It takes time. A value add here is we're getting that information as it becomes available, recalculating it every night. So with the latest and greatest information and data points, we can generate a score to identify if that obligor or credit is trending stronger, weaker, or neutral. So that's why we call a credit momentum score. It's more timely and forward-looking, in our opinion.
should should we view the scores as credit ratings, trend indicators, or something else? How would you interpret them?
So the credit momentum score is not a rating. It is, and it's not a probability of an upgrade or a downgrade. What is the indication of the strength of the underlying credit and how those underlying ratios are moving? Are they strengthening or are they weakening?
So it's fair to say it is credit screening tool more than actual rating.
Exactly. It's a screening tool to identify if the fundamentals are strengthening or weakening, which paired with a credit rating is very helpful. So let's say you have AA stable. Now you could have a AA stable with the bond value credit momentum of stronger, neutral, or weaker.
We're trying to replace and the analysts here, right? We're just trying to help their productivity in a way.
Correct. This is not going to replace credit analysts. You obviously still need the credit analysts and will always need them. This allows them to be more efficient with their time and productive. So, for instance, a few years ago at my prior firm, we were responsible for 3,000 unique municipal obligors or credits. And even if you spend 5 minutes on each one, that's going to take hundreds of hours to do. By utilizing this type of tool, you're able to screen all the credits that we have coverage for and identify the ones that are trending stronger versus weaker. And let's say you have a handful that are trending weaker and they are lower rated, let's say triple B minus, you can focus on those problem child credits versus a AA that's trending stronger. So this way it gives back time to the analyst to focus on the credits that need that extra attention.
That sounds great. Let's move on to relative value. What exactly do you mean by that?
Regarding relative value, that's looking at the underlying, the technicals, the price and yield. So for instance, we're looking at the CUSIP and seeing what that yield is compared to the benchmark yield curve rate. So if we go to the next slide, to really get into the weeds, that black line in the middle is the yield curve. So let's go with a single A muni with a 5-year maturity. That's yielding in this chart for example reasons 3%. Now let's say the CUSIP you have is yielding in this example over 4%. Obviously the market's much tighter than that, but for visuals, we don't want it too small. That would be cheap if it's beyond that upper threshold. And conversely, let's say it's below that red line that's dashed and it's below 2% at that node. That means it's expensive. So what we're doing here is we're generating every hour, if not sooner, a yield curve to compare the bond you're looking at to and looking at the threshold difference. And if it's within that threshold, let's call it 20 basis points, then it'd be fairly valued. If it's above in yield compared to the benchmark yield curve rate, it's cheap. And if it's below that threshold for a particular CUSIP, then it's expensive. So this is an easy way to compare a CUSIP to what we call as a market rate. A lot of different practitioners compare the CUSIP to itself, which is still very helpful, but that's backwards looking and historical. We want to make sure we're incorporating timely information. Especially over the last 18 months, we've seen dramatic movements in treasury rates. And we want to make sure that we can factor that information live so we can determine if a bond is cheap, fairly priced, or expensive.
In other words, what we're doing is we're comparing the spread to the appropriate part of the curve. And then if it exceeds or is under a threshold band, so to speak, right? Then that's how you determine whether it's cheap, fairly valued, or expensive, right?
That's exactly right. And we're making this very flexible and customizable, where you can put in your own threshold. So we have our own methodology for what that could be, but our clients are able to put that in for themselves. So they can implement their own proprietary methodology for cheap versus expensive, but using that same process of seeing the spread difference compared to the benchmark yield curve.
now we're using a yield curve that kind of updates how often during the day, Michael?
At least every hour and soon every 15 minutes. And as we want to be yield curve agnostic, where we're going to have multiple yield curve providers. So that way, as soon as they get them, we process it and we display it. So if you have a preferred yield curve provider, we're looking to provide that to you through this tool. And then as you see on the screen, we were just discussing relative value. The yield alpha is that spread or difference between the CUSIP you're looking at and the benchmark yield curve rate. So we'll give another example. Let's say the bond you're looking at is 3.2%, and the yield curve for that particular segment is 3%. That would be 20 basis points or 0.2% of yield alpha over the market rate or benchmark yield curve. And what's really nice about this is now you're able to quantify the difference for your clients. We go to the next slide.
So the bond's summary score brings everything together into a single recommendation. Isn't it correct?
Exactly. So we figured, okay, we're streamlining the credit fundamental analysis side, and we're also streamlining the relative value side. Why not combine both of those metrics into one simple score that's easy to follow, like a red light, green light situation? So if we go to the next slide regarding the bond summary score, we have a matrix. On the left side, you have relative value. So the outcomes could be cheap, fair, or expensive. On the right upper side, we have credit momentum. It could be trending weaker, it could be neutral, or trending stronger. Now, when we combine the two into the bond summary score, let's say you have a bond that has a relative value score of cheap and a credit momentum score of stronger. That would be the upper right-hand side of the matrix, and it'd be strong, that green color. Conversely, let's say you have a relative value score of expensive and the credit momentum is weaker. That'd be the bottom left-hand side, that red square, or rectangle, I should say, which is weaker. So this way, you could even filter just on the bond summary score to identify options you want to buy, what you want to lean into, and what you want to avoid if it's expensive and the fundamentals are trending weaker from a credit perspective.
Oh, great. So let's talk about coverage. What kind of coverage, either by CUSIP or by sector, can we expect to see with the current version of the app?
And really, that's where the rubber meets the road. This was impossible to do beforehand because the coverage in the municipal space just wasn't there. Now, with DPC's extensive municipal bond database, we have extensive coverage across most municipal sectors, whether it's state, local government, K through 12, community colleges, and so forth. And then we do have two that we're onboarding now, charter schools and transportation, have the data, just need to build it out into the engines and do the back testing. So extensive coverage on the municipal side and growing each month. On the corporate side, we have that parent sector right now, corporates. And we will be bifurcating that. We're drilling down into it, financial institutions and subsectors over the coming months. So if we go to the next slide, we can see CUSIP coverage. So currently, BondVALU has coverage of 24,000 municipal obligors of the universe of approximately 40,000. When we look at the tradable universe, that's about 80% of the tradable investment grade universe for municipal. So very, very impressive coverage. Regarding corporates, 12,500 obligors, and that's about 95% of the tradable investment grade universe. And then if we look at relative value coverage, as long as we have the CUSIP, the yield, whether it's yield to maturity or yield to call or worst, whichever we are looking at, and then the credit rating curve, we can calculate for corporates AAA to single B, and for municipals AAA to triple B, which is, we never want to say 100%, so we'll say almost that, 99% of the universe, as long as we have those data points, which are readily available.
It's pretty impressive coverage, Michael. So
thank you.
It looks like you already have some useful default parameters built into the app. But what if we wanted to play around a little bit with some of the factors? Could we do it?
Absolutely. So I am not a flexible person. We wanted this app to be much different for me in that regard. So we create a lot of flexibility in this app. So if we go to that top left where you see that green square, that filter button, once you click it, we can see that you can customize and filter and screen on different parameters, because that's what we're doing. We're looking at a large universe of thousands of bonds that you can choose to buy, and we want to filter for key metrics that would be advantageous for your clients and portfolios. So you can filter on yield, the curve percentage, yield alpha, basis points, also on the core factors or metrics, credit momentum, relative value, and bond summary. If we go to the next, now let's go run through an example. Let's say you have a portfolio, you had a bond mature, and you want to replace it. So we're looking to buy a bond here, and let's say it's hold to maturity. What we want to do is find a bond that has a cheap relative value, has a high yield, lower price, and it's going to have a good return profile. But also we want to make sure from a credit perspective, it's not going to cause any issues down the road. And it's currently, let's say, fair to trending stronger. So from credit momentum, we can set the filter on stronger. And for relative value, you can set the filter on cheap. This, and for the bond summary score, will only show you bonds that are described as strong. So these are bonds that would likely be good to add. You're getting a high yield, and there's diminished risk relative to other bonds in a similar category. Conversely, let's say you're performing credit surveillance. Like, I had, previously it was 3,000 obligors I was, had to look at and see what was going on, making sure we got rid of any of the weak links, so to speak, to avoid any problems. So from a credit surveillance perspective, what you could do is filter for weaker regarding the credit momentum score, and also filter for a relative value score of expensive. If I'm going to sell a bond, hopefully I can get a decent price for it before it gets downgraded and the price takes a hit. And then these would be bonds that you could consider, liquidating from the portfolio. Or even better, for certain credits, this is the time where your credit analysts, for those credit momentum scores are weaker, they can focus and drill down on those particular credits. So you start off with thousands and then maybe have a few dozen or more bonds that are classified as weaker regarding credit momentum. Now they can focus their time and sufficient time to make sure and evaluate whether they're willing to hold on to those bonds or if it's time to sell. Now, regarding adjustments, as we said before, I am not flexible. I can barely put on my socks, but we want this tool to be very flexible. So you see the 3 dots on the right side. So if you click that, you have the ability to make adjustments. So right now, this data comes into the app through an API, or if you prefer a CSV file, you upload. And let's say you want to make some adjustments to the yield or the rating curve. Let's say a bond is AA, but you think, this really should be a single A. You can adjust and play with the parameters to see what the output analysis would be for that customization feature. And then when we go to the next slide, you can see when you do make adjustments, there is the adjustment value marker, which is indicated by a yellow, I know it's probably small on the screen, it's a yellow dot. So that way you know that is an adjusted factor or metric, and then you can save it or you can revert it back depending on what you're trying to accomplish.
Any potential for further customization, either with the current or future versions of the app?
Absolutely. And this is really what's key here is feedback. We're looking for criticism. We're looking for feedback. We're looking for suggestions. And we've received that over the past, 2 years, let's say. And with that, we made the columns be dynamic where you can sort them and filter them as you please. And we're adding additional parameters to this. So we want to make sure we meet you where you are regarding the customization. So that's the goal and vision of this platform, is to not just be a screener, to be your proprietary screener. So that way you can implement it as you please.
Yeah, as I'm listening to you, it occurs to me that you could also use the app for client onboarding. I'm thinking if as an SMA manager, you get a new client's portfolio. You can probably run it through the app and identify what holdings to keep, what, which holdings to add to, and which ones to get out of, right? It's an
Ab-
interesting, use case for the app.
Absolutely. So I've used this myself, and we've had users use this as well for business development. Let's say you have a prospect that has a legacy bond ladder. What you could do is run it through the tool, identify areas of weakness within the portfolio, and have that be your base case. Then you can use a tool to optimize it, getting rid of bonds that are trending weaker and maximizing yield. And then you can show the before base case and then the after optimized. And then you can, through the yield alpha, actually quantify some of your value add or potential excess return to give them idea of what you can do for them. Because obviously, the experience you all have, the teams, the brands, that is very powerful. But what's even, could help facilitate new business development would be able to show something tangible and walk them through visually of how you apply that experience and teamwork to add value to your clients.
Well, thank you, Michael, for a very thorough demo. It certainly looks like a very useful tool to me. Now, with all of that, at the end of the day, our users must be able to justify the cost, right? So have you tried running any kind of cost saving analysis?
Yeah, as we know in life, especially when it comes to business, it comes down to dollars and cents. One thing I do want to emphasize is this tool is not meant to replace people. It will not do that. It will help teams become more productive. But with that productivity gain comes cost savings. So let's say you have a credit analyst that you pay about $150,000 a year. That's $75 per hour. Let's say to do a high level review of a bond, it takes about 5 minutes. The cost per bond review is $6.25. So per 1,000 bonds, that's $6,250. And we look into time savings. Go to the next slide. Now regarding time savings, so let's say you're reviewing that 1,000 bonds per week. That's 83.5 hours. Hopefully that's not one person. I hope for whoever's doing that work, there's 2 of them so they can have a decent work-life balance. But that would equate to 2 full-time employees regarding the amount of time it takes just to spend 5 minutes per bond doing 1,000 bonds a week if you're an SMA manager going through all the available universe. And here's the thing, especially with SMA management, there's a lot of opportunity in these more thinly traded securities that don't have as much coverage, the smaller entities out there. That's what's could really add some value and get some yield pickup there. So if we go to the next slide, so while we have additional financial benefits, we also have a potential for return alpha. Nothing is guaranteed, and these are theoretical. But let's say you have, for the yield alpha spread, you have it set at 20 basis points. So let's say the benchmark yield curve rate, you have the threshold above that for cheap at 20 basis points, and you're only buying cheap bonds. Theoretically, you should be able to produce 20 basis points of alpha per trade. And if you buy and hold to maturity based on notional or face value, for every $100 million worth of bonds you own, that'd be another $200,000 a year in income or additional return. Per billion, that'd be $2 million in additional return or income per year. These numbers get big as you add more AUM to it, and it can be quite surprising. If we go to the next slide, regarding corporates, tighter spreads, more efficient markets, let's say it's 15 basis points on 1 billion face value. That could be 1.5 million additional income or return a year. And once again, nothing's guaranteed, but this just shows how you can potentially quantify value add to your peers and to your clients.
Well, that's a lot of dollars and cents, Michael.
It sure is.
Yeah. How else can our users access all this data besides going to the web-based portal?
Yes, so we have the web-based portal, but also it's available through an API. And we want to meet you, as I said before, where you are. So we're open to suggestions for other delivery mechanisms, but right now this is what's available, and it will be expanding moving forward. And one thing we've really emphasized, being a user of technology services, we want to make this as easy as possible to use and to integrate into other systems. Because nothing is worse than when you have 3, 4, 5 different systems that aren't communicating well, and you got to keep hopping in and out of different applications. We're making this, it's easy to integrate, and we want to have a one-stop shop.
Flexibility is the key here, right? As you said before.
Unlike myself, yes, flexibility
Yeah.
for this application is key.
Right. So how would you summarize the bond value proposition, Michael, at this stage?
Absolutely. So I would say there's 5 value components. One, as we mentioned before, is business development. You can leverage our credit momentum and bond summary scores to differentiate your offerings and gain a competitive edge in the market. Time savings. When you're streamlining the screening process and the selection process for bonds, also you can streamline the credit analysis, whether it's portfolio construction or surveillance. Money is time, and this gives you back time. That goes right into money. Cost savings. By boosting efficiency and productivity for your traders, credit analysts, and portfolio managers, they can spend time on those more complicated credits regarding credit analysis, on business development, or on other priorities of the business, or on servicing or meeting with clients. We want to make sure for the things that can be streamlined, we give you back that time so you can spend it on areas that really add value in other parts of the business. And then custom solutions. We're making this flexible and customizable to suit your needs. And finally, compliance. Not the most popular item, but when it comes to surveillance, ensuring a systematic rules-based system can be beneficial. Because when you're conducting research or analysis, it doesn't hurt to look at it through a different or multiple lenses. So while you have your credit team doing the research, as is today, this could be another way or lens to view the credits to see if there's any, troubled credits that need a second look or a double click into.
Wow, sounds like a pretty compelling value proposition. Okay, I think we probably should stop here to give our audience a chance to put in some Q&A. Ken, we have any question out there?
Of course, we did can a few, but I don't think we're going to need them actually. So there's a bunch here, and I've been looking through them. One question, I think it's something that was might have been addressed already, but maybe a little clarification. One is for the relative value. Does the client provide the value of the CUSIP, or does DPC have their own value or use a third party? So it might be good to clarify that again.
Me or Triet?
Oh, you could do it, I guess.
Why don't you take that?
Yeah. So regarding that, the client provides the yield of the CUSIP. So that way, when you're looking at a specific offering, we can provide you insights on exactly the level you're looking at versus a prior day, level, because they can vary greatly, between yesterday and today and different offerings.
Great.
Yeah, don't forget we're dealing with nearly live curves here during the day too, right? So it's probably not possible for us to keep up with with the pricing, and not that we want to do that. That's not a space that we want to be involved in. But it is a on the part the part of the client to input the yield that they're looking at.
Right. Okay. Another question is, why did it take so long to develop something like this? Is it available anywhere else? Has it been used?
I'll take this one. This hits close to home. So we were talking about pain points previously. I was looking for a solution because I go, there's got to be an easier way to do the surveillance and screening and not have to worry about a credit going belly up, down the road. And I couldn't find anything out there. And I was trying to think about, first principles, approach. Why is that? Why doesn't this exist? And it was because the data wasn't available. In the municipal space, getting that underlying financial data is very challenging. You have credits and localities that have cash-based accounting, accrual, modified accrual. Every state and subtype is different. And what was beneficial is DPC built out this incredible database of now 25,000 obligors that has that data. And once that data became available, we're able to overlay that with the credit ratios and sector-specific engines to actually generate these scores automatically. So really, it wasn't around before because the data wasn't available, which it is now available today. And I'll say one thing: there's some, and some folks try to scrape information, and it can work, but as we know in this space, with the type of audits we're receiving, you have to be really careful with that. So having someone and multiple individuals looking at audits the second they become available, getting the right information, being trained in specific sectors means you have better quality data. Because if you don't have good quality data, the output's going to be garbage.
Yeah, I think just to add to what Michael was saying, we're not saying that the data was completely unavailable before, right? But I think what DPC brings to the table is we have no size limit, the size cutoff at all. If an issuer, however small it is, has publicly disclosed financial information, we collect it. So whereas I think some of the data providers out there tend to stick with the larger cap issuers, right? And they may cover the smaller issues, on upon special request, which can be very expensive. But in our database, we capture everything. If it's available out there, we capture it, and that kind of makes Michael's job a little easier because he doesn't have to go worry about a thin coverage of smaller issues.
And to build upon that, what's nice is when there is a credit that currently doesn't have coverage, if you let us know, we add it to that month's intake form. So that way, every month our coverage of different credits and obligors is expanding because we're filling the holes of what isn't currently covered. So that's been really helpful. Because if you have a tool and only covers 30% of the investable universe, you're really limiting yourself and everyone else's as well. So you're bidding up the same credits. By expanding the investable universe to some of these smaller, more thinly traded credits, there's more opportunity and value to be had because there's less folks looking at it.
Gotcha. Okay, we'll move along. We don't want to keep everyone too much longer, but there's multiple questions around the corporate bond benchmark yield or just benchmark yields, yield curves in general. So one of them is, how are corporate bond benchmark yield curves calculated? Another is, we're using a vendor, which one? Maybe you can give a little more insight into the benchmark yield curves.
Absolutely. So we do use a vendor, SQX, and we're also we want to be vendor agnostic, where if you have a different preferred vendor, you want to be able to plug and play. So you can use your preferred yield curve providers, and it spreads off the treasury. And that's actually updated every 15 minutes for corporates.
Great. Let's say another one. How far back does the data look to predict momentum trend?
So we're looking at 3 years of data and taking the average of that looking forward. So that way we can see clear trends if it's strengthening or weakening, which is consistent with rating methodology out there.
Okay. Let's see, there's another question about how frequently does the credit momentum data change? How soon after financials are available do they reflect in your models? I think you might have mentioned something like this already, but.
Yeah, so regarding the timeliness of it, as soon as, let's say, for a municipal, the data becomes available online, it's publicly disclosed, and the DPC team enters it, reviews it, and checks it, it's an overnight processing. So as soon as it hits, and that's really one of the advantages we have, or it's like a time alpha, because sometimes if it's going through the full rating process, I worked at S&P for many years, a great firm, they do a great job handling so many different types of credits, but you have a little more red tape, so it takes longer to get the data, analyze it, go to investment committee, write the report. Here, we're able to do it in a much faster, streamlined way, and it's all quantitative based. We're not, making adjustments based on opinions. So it's really just a rules-based quantitative system. As soon as the data hits, it refreshes every night.
Okay, I think we'll take one or two more. Another one is, I think this is for Triet. Well, Lisa, it says for Triet, how would you backtest the credit momentum score models for sectors that are largely unrated?
I think that is something that we thought about a lot. Micro's current methodology is to backtest against actual, rating changes, right? And trend changes. When it comes to non-rated issuers, obviously that approach doesn't work. So what we will do is really backtest against spread changes, because then we'll let the market tell us what's going on with the credit, and we'll try to capture that.
Gotcha. Another one just came in. I think this is a very good one. I think I know the answer, but it's how can a user generate a comparison report when suggesting replacement bonds?
Absolutely. So with the filtering mechanism, you can have the initial, let's say, upload of the legacy report. And then once you select the replacement bonds, then you can have that second file of the optimized and then have that saved on your dash. So we have the ability to save different portfolios within the system. So that way you can compare and contrast.
But it's not necessarily a one report, before, after kind of thing, right?
Correct.
Yeah. Let's see.
And we are building out the reporting capability. So if you do have suggestions of what you'd like to see, let us know, because down the road we like to have the ability to really have some clean reports on top of what we currently have to make your life a little bit easier.
Gotcha. Just one more I saw. I think this is good to clear up. It says, what parameters do you account for to create comps for relative value before ratings? Beyond ratings, sorry.
So what we're looking at is we bucket by if it's a muni or a corporate. And on top of that, we look at the maturity or, the yield to worst or call dates. And then based on the maturity, the rating, and the asset, the type of bond it is, that is the bucket. Now we have heard some suggestions. Well, what about revenue versus GO? We are looking into options to become more granular with time. But what's really important is you want to make sure, especially for the lower rated credits, you have enough observations. So, if you're looking at, very low rated municipals and you're whittling down the available universe, it's less reliable. We want to have as many observations as possible to construct that yield curve so it's more reliable and consistent across all maturities.
And this is where DPC's more granular sector classifications can be helpful, right? Because we have actually the three layer deep sector classification methodology. So you can really get down to comparing true apples to apples as opposed to apples to oranges. One of my favorite example is with the some of the legacy vendors. If you could, everything is in transportation, and then you end up comparing a parking facility to an airport bond, which is they're both in transportation, but they're completely different animals. So given our sector classifications, I think you'll be able to really get down to some fairly detailed comparisons.
And also, it's sector specific for credit momentum scores. So it's not one big bucket. You have state, you have GAAP, non-GAAP. It really bifurcates it down based on the type of financials we're receiving. So it's because obviously a state is going to look much different than a hospital system or transportation bond. So they're going to have different types of key data ratios and factors and at different weightings. So it's tailored to the specific sector.
Okay. I think we'll wrap it up. I saved this one. This is a good one. It says, Michael, in your current position as a CIO of a SMA firm, are you actually using BondVALU right now? Yeah, I'd like to hear the answer to that as well.
Yes, yes, I am, and it's been very helpful with business development. Like I said before, it was about 2 weeks ago we did actually win a client doing that before and after analysis. So I have firsthand experience on the front lines, and I actually think that's one of our benefits. We talked about before how we have experiences from 4 different parts of the industry, whether it's research, data, technology, or on the buy side, trading, portfolio management. Being on the front lines, it's helped me work with the team to develop this tool, see what is actually needed, and actually utilizing it in practice has been beneficial with adding enhancements. But we always want to have more feedback, because the more feedback we get, the more critiques we get, the better we can make this tool.
Great. I think we'll wrap it up there. If you guys, thank you for joining. We've had a really good discussion, I thought, and really good questions. I appreciate that. I didn't have to use any of the canned ones we came up with. And if you need more information, you can go to dpcdata.com, our website, and look for BondVALU under products. Of course, you could send us email at sales@dpcdata.com. And if you are already a subscriber to BondVALU, obviously you know the URL, or you might not. We changed it recently. It used to be BondDATA, now it's BondVALU. So I don't know, anything else, Michael, Triet? If nothing, we can give everyone back some time.
Well, I think feel free to reach out and get a live demo from us. I think there are some other neat features that we didn't have time to cover today too. So I think it would behoove you to kind of try to get a live demo from us.
That'd be great.
Absolutely.
All right. Thank you, everyone. And thanks, Michael. Thank you, Triet. We wish everyone have a good rest of your day and a good weekend ahead. Appreciate it. And like I said, we'll be sending you the link to this recording. Thank you.
Thank you.